Evening, folks. Friday night. What a day it's been. Oh my gosh, I think I've got a bit of a tan going on. I might even be burnt, actually. Can you see that? It's Friday night. I've spent most of my day, I don't know if you can see, most of my day has been preparing painting with a very special low VOC oil. Floorboards, there's a whole stack outside there as well. And getting ready for the next stage for the builders. But I wanted to tackle this question, which actually came up at a training I was doing last week on real estate. And also, it comes up quite a lot with investors that have been holding their properties for a while. Now, remember, I can't give you advice. Go seek independent financial advice. This is me sharing with you my own experiences as an investor for nearly 20 years now. So the question is, should I sell my properties or not? That I'm holding on to. Now, actually, funnily enough, we are just having that conversation with one of my businesses at the moment. And I think there's a few considerations here. So let's say you've bought an asset. It's been cash flowing for you for, I don't know, maybe 3-4 years. And it's gone up in value. You've got some nice cash flow from it. And actually, that value and maybe the way the property is operating at the moment is such that you actually have the ability now to sell it, take cash out the property, go do something with it. So the question I get from people is, Dr. Rowe, should I sell this property? I mean, over all the years I've been in front of audiences in the lunch breaks, the coffee breaks, we're obviously online now, so these questions are starting to come through on the online training that we do, is I've got this property, should I sell it or not? So here's some considerations. First consideration is this: what is your long-term plan? What are you intending, not just with this property, but your overall portfolio? Are you looking to continue that passive income that's coming in from this and many other properties? And if so, by letting go of this asset, what would be the drop in your cash flow? So that's a question that I have asked in the past when I have sold properties. I do know investors that their philosophy is never sell. They just hold, rent, potentially refinance once, maybe twice, but they don't want to be over leveraged, and then they just hold the asset, etc. But situations change, life changes. I've been faced with that over the years where I'm in a situation where I need to liquidate something, bring the cash back in, or maybe I'm seeing an opportunity in the market where actually by selling this, I can release this much money and it can go into a bigger deal or 2 smaller deals that produce more cash flow. And that's what we're facing at the moment with one of our deals. So it's kind of appropriate this question's been coming up. So, for example, we have a property that if we sell that property, bearing in mind the value's gone up and you pay off the mortgage, the net proceeds from that would be enough to buy 2 properties that we could do with a guaranteed rent scheme and produce more income than the individual property on its own. So this is the point of me asking the question: what is your long-term plan? So if your long-term plan was to increase a sustainable passive income, for example, then it might make sense to ask the question, okay, if I sell this property, my cash flow is going to drop on this asset, on this portfolio. Let's say I've got 4 properties, you lose 1, so now you're going to have 1/4 of your cash flows stopped, assuming they're all the same. But let's say that particular property's gone up in value to such a point that maybe you bring out 80k from the sale of it. Now that 80k could be split in 2 and could go down as 20 grand deposits on £80,000 properties, for the sake of argument. So now you can get 2 £80,000 properties with £20,000 deposits, and the 20k each for each of those properties you've also got spare, because remember you've got 80k spare, 40's gone in to buy the 2 properties, the other 40's used to renovate those properties. So now you've renovated 2 £80,000 properties, and it just so happens that you've renovated them to be 5-bedroom HMOs, houses of multiple occupation, and the cash flow from those 2 properties, let's say for the sake of argument, is £700 a month. So you've got £1,400 a month coming in from 2 properties now, and it just so happens that you've given them over to social housing or asylum seeker or special needs or whatever under a 5-year contract. So what have we done? We've taken a HMO that you already owned. It was producing maybe £900 a month cash flow on its own, but it happened to be in an area which had gone up in value fairly fast, or you've added value, or you've got an international investor or a London-based investor or a southern investor or somebody that's got a lot of cash, they buy it on yield. So they buy your property, which was producing 900 a month net cash flow. And the £80,000 that you've released has bought 2 properties, each worth 80. Now the total value of those 2 properties is 160, but the net cash flow is, what did we say? I think we said 700, did we? Is 1,400. So let's say 750, that's 1,500. So you're looking at 400 to 500 pounds a month more cash flow. Add that up over a year, that's 5,000. Add that over 5 years, that's 25,000 pounds. And not only that, these properties are hands off. So you're now facing a 5-year guaranteed rent net cash flow of £1,500 a month. I'm just rounding it off now, so they're 750 each. Hands off, hassle free. So if your strategy was to increase your cash flow and reduce your hassle, then this would be a good strategy. If your strategy was to increase your capital growth and have a higher asset value, then it might be that the other property, that may have been a southern or a Midlands-based property, could have appreciated more than the 2 that you've just bought. So again, it's a balance. So I think they're the sort of considerations. Or it might be that you are in a situation where you need to consolidate some debt. Maybe you've got to pay off an angel investor. Maybe you've got to pay off some personal debt, and by selling the property, it allows you to do that. So these are the considerations you have to make. It's not as simple as saying, oh, should I sell or should I buy? I always ask when I'm coaching somebody, if I'm teaching them, okay, so what would be the consequences of the sale? What would it do for you? It would release some capital. What would you do with that capital? I'll pay off my debts. Okay. Well, is there another way to pay off your debts? What do you mean? Well, if you sell the house, you lose an income. But what if you have an angel investor that's prepared to lend you money, or an uncle or an auntie, or you could do money transfer, credit cards, loans, whatever, something else to consolidate that debt. Ah, that's a good point. I hadn't thought about that. Okay, we'll go check that out. Could it buy you more income? In this case, it did. We split it, bought 2 properties. What if those 2 properties you bought for £80,000 happened to be in an area, by adding value to them, you buy them for 80, put 20 into them, now you're in for 100, but actually they refinance at 135. Whoa, hold on a minute. That means I could refinance those 2 properties in, say, 6-7 months' time and pull out a good chunk of my 80. Maybe not all of it, but you might pull 50, 55, 60 out. That could allow you to go do another 1, possibly 1.5 properties. Well, let's say even just another 1. You've added, and it's the same strategy. So now you've done a 3rd property in the same area with the original same 80,000. It went into 2 houses, you refinance them. Ideally, you want a money in, money out, but you don't always get that. That's what I teach when I'm doing my 3-day trainings. You have the money in, money out strategy. But let's say you don't. Let's say you, out of that 80 that comes in, you only pull out 50 of the 80. 30 gets left in there. Whoa. Okay, so 50 goes in to buy another property. That's 40 needed, 35, 40 needed. You do another one in the same area, and now you've got another 750. You've got £2,250 a month cash flow. You've more than doubled what you originally had with the original capital. So this is the way we have to think as an investor. We've got to think beyond our current circumstances and ask the question, does it work out to hold this asset or to sell it? And if we sell it, what can it do for my overall strategy? And I think that's probably the best answer to the question. In the meantime, I am listening to Malcolm Gladwell, and it's Talking to Strangers. Wow, and that's a great one. I might actually do a bit of a live on that, because it ties very nicely into my CWI content where I talk about certainty when you're talking to people. It's getting chilly, and I've got to bring in the rest of the boards. Have an amazing Friday night. I shall see you possibly over the weekend.